Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim, and here we go with our Friday, well, let's call it an unroutine, because there's some wild things going on out there.
We're never routine, Bob. That's why people like the show.
Yeah.
We have two questions from our frequent questioner, Michael. The first question, many financial advisors maintain the economy has a lot of pent-up demand and that the stock market will skyrocket from here as the economy opens up, even though the stock market is higher now than it was before the pandemic. They point to the high flying of late resource sector and a thumbs up from Mr. Copper. I think it's called Dr. Copper, actually. Bob,
he's been demoted to Mr.
Just
Copper.
Mr. Well, in Britain, they call surgeons and dentists Mr.
That's right.
Not doctor, so we'll pretend that he's English. Bob, how can the economy experience a skyrocketing recovery in the wake of all these business failures and unemployment?
Yeah, Michael, thanks for your question. And the way I've been looking at it is that for months I've been writing about the economy as weird, because you had an absolutely unprecedented crash in employment, forced by unprecedented policy determinations. So that hit the economy, and the NBER did determine that the recession started in February, but looking the other day, I saw that in Germany, their recovery is out of the first crash is considered as a recovery. And we haven't had the same comments in the States. Now, on top of this, we want to look at the bigger picture, where you have an incredible financial boom going on. And as you point out, copper's been firm. Base metals altogether have been firm. Lumber has had some fabulous rallies, and even crude oil firmed up. So the way to look at it is that the crash in employment, as tragic as it was for those unemployed, wasn't really a recession. And without that, where would the boom have been? Hey, it would have been great. So I think what we want to look at is that when you're in a wild financial bubble, and in past ones provide the example, like 1929 or 1873, once the bubble is over and heads down, it takes the economy with it. Whereas in ordinary bull and bear markets, the stock market leads by 10 to 12 months. That's why the authorities have their leading indicators, and in it they include a weighting for the S&P. So, anyways, the way to look at it is that this stock market is probably blown out, and the games with it, specifically on copper. Earlier in the week, we got our technical things said sell. Also on the commodities, the CRB, we got a sell on that. So what we're looking at is that the the street is fallen into its 1970s thinking where they figured out that the Fed is evil, it's going to print, and commodities will go up forever. But they don't understand that you get a decade of inflation in commodities, crash, and then you get a decade of inflation in financial assets, which we have had now. There's no question that the big game has been financial assets. You've got the S&P at never land valuations. And one telltale thing about inflation and financial assets is that the German 10-year note has gone to minus yields for the first time in history for any instrument. And that, my friends, is the equivalent of gold going to $30,000. So the inflation has been in financial assets, and this could be blowing out now, in which case everything gets to go down.
Michael has a second question for us as well. It seems to me that financial forecasters think of the pandemic was like a war, but in a war things are broken and the economy has to physically rebuild from the ruins, thus creating jobs. However, in these pandemic lockdowns, nothing physical has been broken with all the physical structures and infrastructure still in place. However, many people have instead experienced financial ruin, loss of savings, family problems, and severe mental distress as a result of these lockdowns. Bob, how will a post-pandemic recovery really look like, or are we in store for major financial and political aftershocks?
Yep, I think we covered that this is going to go into aftershock. It seems like a high probability. Then also with the pending change in the U.S. government to full-on socialism, the destruction of wealth there could be quite impressive. So there's two aspects here. One, the likelihood of a cyclical contraction, which we will know with more confidence in the next few months. And then there is the other of an extraordinary political disaster. Now, this ironically has got all the old inflation bugs going. They're saying that with the new administration and the Democrat control of Congress and a possible new central banker even more dedicated to inflation, that's just going to go wild. But I think that all of that is in the market, and I still think the risk is going to be to the downside.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your attention today: warning, bad debt surge threatens India's financial system. What's going on in India?
Oh, when you get a headline like that, it reminds us that when you're in a great financial mania, and we in Canada and those in the U.S. have a tendency to look at the Toronto Stock Exchange and the New York Stock Exchange. But hey, this wild speculation is everywhere. And that was the case with previous bubbles, like 1929, it was everywhere. And then when they go bad, it's everywhere. So, and this is the time now, when it takes out our line in the sand, which people can get in touch with us for, then what will happen is that the power shifts from central bankers being able to push liquidity in the market to being overwhelmed by margin clerks, calling in loans or, forcing the crack in the market. So in every post-bubble contraction, or actually in any bear market, the power shifts from central bankers to margin clerks. It's as simple as that. And, I know what we'll do. We'll add that the job description of a margin clerk is to get the accounts in line, no matter what. And then, of course, the job description of a central banker these days of recklessness is, of course, to get the accounts out of line. The central bankers need to have everybody speculating so that they can get their portion of the credit expansion out. But the problem is that once the speculators are burned out, there is no demand for speculative funds, and the Fed can't get the stuff out the door. So we're heading for a potential contraction, and we'll keep our subscribers advised on the inside timing on that.
Bob, right now we have a record high margin call debt. What does that tell us?
Well, yeah, they keep track, the NYSE margin debt outstanding, and it's huge. But that one is usually a month and a half behind reporting. So all it says is, hey, the margin is there. So that's a good point, Jim.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that caught your attention today. The Hang Seng Index is under pressure as funds are avoiding Chinese stocks.
Yeah, that's the Hong Kong index, of course, and it kind of, decades ago, before China became an economy, the action was Hong Kong, and it was an important regional market, and now it's sort of ancillary to the Shanghai. But anyways, that was the excuse given for the decline, a recent decline in the Hong Kong exchange. But what we want to note is Hong Kong. Then we had a news item on India, so it's everywhere. But I just found another terrific headline here. This was just January the 10th. Quote, full-blown mania. Stock market jackpot. Bells just keep ringing. Jim, and our listeners, you don't find that kind of a headline at the bottom of a market.
Well, I know when the bells are ringing, it makes you put more money into the slot machine you're working because you think you're going to win as well. Am I putting money into something that's about to crash?
Yeah. Gosh, the final stages of a powerful bull market are always compelling because, one, you're on the trend, and it's very comfortable, and it is making you money. And then the other one is you've got more seasoned traders out there who can look at the overvaluations and say, boy, I'm going to play the short side. So people get short. And if you're short in this kind of a market some weeks earlier, you can get a final thrust in the market that then puts you offside. So then the final thrust of a speculative market, it can be the bulls buying enthusiastically, and it's also accompanied by the bears, the shorts, being forced to cover. And this is then where you end up at the point, sometimes these can, well, over the last while there's been some reported as such, some massive short squeezes. And then what the function of short selling is, in normal times, is that then when the stock market does go down, you've got all those bids from the shorts that, have to cover. So I'm telling you, shorting the stock market is a very important part of actually providing liquidity to the market. Now, further on short selling in some smaller cap stocks, it can get pretty nasty as the bears will intentionally raid a stock and sell on the downticks. But the way to protect that is to have the short sales allowed only on the upticks, and then it's healthy. You then can't gang up and actually kill a stock. That was the case back in the 1920s when the New York Stock Exchange was rather wild, and there would be organized bear raids on a company, or they had organized bullish pools on a specific company, and in manipulating the trading and the volume could encourage a rise in the market. And of course, the whole game with a bull pool was to get everybody in, help the market go up, and then always to get everybody out. So, and in a bear raid, it's just to, kill the market and make your money on the way down. And I support shorting, but not bear raid shorting. That's not good stuff. So, but I think we're going to have a chance to watch all kinds of different action in the markets. The other thing that's interesting here is that with a rise in the stock market like this, it's accompanied by a strong move as credit spreads narrow. Of course, that's the difference between high-grade bonds and low-grade bonds, and in a period of confidence, people don't appreciate risk and then reach for the extra yield you can get out of lower-grade bonds, which is risky. So the action in credit spreads continues positive. We're watching it very close for a reversal. Now, typically in spreads, this doesn't really give sensational technical action, but we can watch for the change, and it's important. Now, the other part of the credit markets is the yield curve, which is the difference between long rates and short rates in treasuries. And in December, it gave us and our readers an alert. And then we can say a week ago, it kind of moved a little further. Let's call it a warning. Now, there's something else that goes on with the yield curve, and that when it turns to steepening, that kind of helps lending agencies such as banks with their lending spreads. So you get a little pop of interest in the banks, but the actual turn to steepening is an indication that the boom is over. So then you have that problem. So we're also watching the banks very closely. As I said, we've got overdone in copper, overdone in general commodity index. Well, everything seems to be poised for the change. Also, the U.S. dollar came down to an oversold level with bearish sentiment, and it is perhaps building a base upon which to rally. Another item is the gold-silver ratio, which we jokingly call the metallic credit spread. And in a boom, in a rally for precious metals, silver will always outperform gold. And then with the gold-silver ratio coming down, and then when you're going into a possible problem in the credit markets, then the gold-silver ratio gets pretty volatile, going, whipping around on a weekly basis. And then you get the moment where the gold-silver ratio number starts to go up, and that is accomplished as silver falls relative to gold. Now the gold-silver ratio is looking like it's turning up, so that's confirming what's going on in the credit markets. So everywhere you look, it looks like things are poised for an important change, and the only important change that could happen would be the end of all of the fun stuff that's been going on over the last year, or since coming out of the panic that ended in March. There's been some terrific market moves out there in most any of the games, all positive, all good and constructive. The orthodox world has been wonderful, but it looks like, here's the gold-silver ratio. It's up 2% today. Now that's a pretty good move, and it's now been rising for a week. So this has got our eye. It would have to do a breakout to really establish the uptrend. So, it's worth watching.
And the last headline you want to comment on, Wall Street most bullish on commodities in a decade. What does that tell us?
Oh, yeah, there's another one. And again, it's the same story, that the Fed is going to be super reckless, and that's going to drive commodities and inflation to the moon. But there are forces going on that may prevent the Fed from being even as reckless as a new Democrat administration and Congress would wish. And if you want to kind of have a little schadenfreude on the side, if the financial markets do fail, and with a Democrat administration and a Democrat Congress, who's going to get the blame? And we will watch that with interest.
Well, everybody likes to take credit for good things. Nobody likes to take the blame when things go sour.
Oh, yeah. Disasters are orphans. I think that's an old saying.